Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, November 15th, 2021, and I'm pre-recording this Trading Places Live for Tuesday, November 16th. Currently, we're showing futures up slightly. Dow Jones futures up 35 points. S&P 500 futures up 5.5. NASDAQ futures up 27.25. We got oil, which had rebounded. It had gone below $80 a barrel, but it did rebound. Last check, crude oil prices at 81.60, which was up just a little less than 1% on the day. And we saw the 10-year Treasury yield dip a bit down to about 1.61%. Coming up on Tuesday, we do have a big retail sales report. We got a number of economic reports. I'll go over those in just a minute, but retail sales will be out. That'll be a big one to watch this morning and see how the retailers react to that report. But before we get into all of that, let me walk you through today's agenda. So we'll start off with the daily market recap, then move into talking technically. Got a big story brewing here for you, and I'll go over that with you in just a couple minutes. Scanning strategies. I'm going to just talk briefly about an uptrend reversal scan. So if the market tops, we start to roll back over. These are potentially some stocks we just want to take a look at, see if they might be ripe to roll over with the market. Then we've got the earnings spotlight, and then we'll wrap up with the 3 you must see. Before we get into any of that, though, let me take you over to earningsbeats.com. Couple things I want to go over with you. First off, it's our fall special. We did start this just a couple of days ago, back on Saturday. It runs for 2 weeks. If you'd like to see the deal, just come to our website, click on that fall special link, and you can see that we have a pretty nice special. Normally, in the past, we've done these specials where you go out a year and you get a couple bonus months. We've actually extended it, so the longer that you want to commit, the more free bonus months you'll get. So 1 year gets you 2 bonus months, 2 years gets you 6 bonus months, 3 years gets you an entire year for free. So if you have any questions, you can reach out to us at support@earningsbeats.com. Love to answer any questions you might have, but definitely check that out. And then wanted to go back over here. We do have an event coming up on Tuesday evening or Tuesday afternoon after the market closes. It's one of the best events that we have each month. Our members love it, and it has to do with options expiration. So we call it our Max Pain event. And so every Tuesday before options expire, and options always expire the 3rd Friday of the month, which will be this Friday. So the Tuesday before that 3rd Friday, we have an event that looks at the max pain, where market makers might like to see the market move. It's really a directional clue more than anything else to try and help us determine in the short term whether the market's more likely to go lower or go higher. I will just tell you that the market appears primed for a pullback. I'll just leave it at that for now. But I wouldn't be surprised to see some selling later this week or maybe into early next week, just strictly based on the options activity. But I'll be going over all of that with our members on Tuesday at 4:30 Eastern. And in addition to talking about the major indices, we'll also be talking about individual stocks that could be set up either to move higher or move lower based on the imbalance in their puts and calls as they head toward options expiration. We've had tremendous success in forecasting some individual stocks that could move significantly in one direction or the other based on this short-term phenomena. So I encourage you to sign up, get a 30-day free trial. And then if you like the service anytime before November 27th, you can sign up using our special. So it's a great time to come on board. The other thing I'll mention too is that on Thursday, we will be drafting the stocks for our 4 portfolios. And if you haven't checked out our performance, here it is. These are the stock portfolios. So this is where we draft what I like to call draft 10 equal weighted stocks for each of our 4 portfolios. So essentially 40 stocks being selected. And the performance this quarter, you can see each of our portfolios. Model portfolio, which was down, actually has come back now, has taken the lead. Our aggressive portfolio, we're just absolutely crushing the S&P 500 right now by 16 percentage points just in this quarter. Strong AD portfolio currently is up 9 percentage points. Income portfolio down a couple percentage points. And then we also provide you the since inception returns, where you can see our model portfolio up 234% since November 19th of 2018. And by comparison, the S&P 500 is up 74% over that same time frame. But all of our portfolios are leading by a wide margin, with the exception of the income portfolio. Portfolio is going to be looking more at the dividend payers and more value stocks, and they just haven't been where the market's been focused over the course of the last few years. It's been more about growth stocks. So not too surprisingly, the income portfolio has trailed a little bit, but still not doing bad. I think fairly close to the S&P, considering that most of the time you're not going to have those high-flying technology stocks in an income portfolio because many of them don't pay dividends. Anyhow, that will be coming up Thursday, the draft. So you're going to need to be a member for that. So again, great time to check us out and take us up on a 30-day free trial. That you will see right at the top of our homepage. So you can just click on that no-cost trial and get things started. One last thing, and then we'll move on. We do have a free newsletter, our Earnings Beats Digest newsletter. All it requires is name and email address. Hit that subscribe button. There's no credit card required. You can unsubscribe at any time. It's completely free. Published 3 times a week, Mondays, Wednesdays, and Fridays. Very brief read. Would love to have you, so you can check that out. All right, let's move on. Take a look at what happened in our daily market recap from Monday. Dow Jones Industrial Average down 12 points. S&P 500 basically flat. That's about as close to flat as you can get. NASDAQ lost 7 points. Mid caps up 6 points. Small caps up 1/4 of 1 point. So really pretty flat action today across the board. Utilities led in terms of our sector performance. Energy also strong. Real estate up a little bit more than 0.5 of 1%. Healthcare, the worst performer, down 0.6 of 1%, and materials down almost 0.5 of 1%. So you had it a little bit on both sides. But what's interesting here is that of these 5, the 3 top and the 2 bottom, none of them are any of our aggressive stocks or aggressive sectors. So I don't know if I've seen that before, where I've done this recap and not had any of our 5 aggressive sectors either leading or lagging. They all were kind of in the middle today. So I think it just paints a picture where the market's not quite sure where it wants to go. And I'm going to talk a little bit more about that in just a couple minutes in the Talking Technically. But first, let's take a look at the 10-year Treasury yield. As I mentioned on Tuesday, we've got retail sales coming out, industrial production, capacity utilization, and the housing market index. So the market's going to have a lot of economic information to digest. You can see the 10-year Treasury yield is now moving higher. Last week, when we got the CPI data, that was hotter than expected. We saw the 10-year Treasury yield move up. We're continuing to see it move up. And as it moves higher, you're going to want to be careful with some of these growth stocks, especially because options are expiring at the end of this week. All it takes is just a little bit of, a little steam coming out of those stocks and starting to roll over, and you could see some selling take place. So I would be very careful because of options expiring, because we do have yields moving back to the upside. I think this, by the way, is very bullish longer term. But just in the very short term with options expiring and growth stocks generally, taking a hit when rates go up a little bit. I just think we need to be a little careful here, but I'll go over some other reasons in just a minute as well. Looking at financials and industrials, when you got the yield going up, these groups tend to do pretty well. Financials haven't really moved up much in the past few days with yields rising, but we are seeing a pretty nice move in industrials, and industrials made a breakout last week. Transports made a breakout. We're starting to see a lot more strength in various areas of the industrials. So I would expect that we're going to continue to see outperformance by industrials as we move forward. All right, let's move on to Talking Technically. And, I've just talked about options expiring, and don't want to lose sight of the market when market makers have a lot of financial interest in moving prices lower. And I believe they're in that position right now. And as long as the market's up or moving up here over the next couple of days, I think that's going to start building more and more pressure on the market, and probably going, I'm going to say, maybe 70, 30, 80, 20% in favor of a short-term top going in here. If not already, then maybe over the next couple of days. In addition to options expiring on Friday, I just want to point out that you can see on a daily chart over the last year, the S&P 500, when we've gotten that PPO up above 1.5 or to that 1.5 level, I mean, you can see here, we went, kind of choppy sideways for the next few weeks until we started to get that PPO down a little bit lower. You can see back in April and May, when we hit this high on the PPO above 1.5 and it started to roll over, the next couple of highs that the market made printed a negative divergence. And look at that quick sell-off. 3 days down from what, 4,250 down to maybe 4,050. So maybe a 5%, 4 or 5% correction or move lower in just 3 days. Now, I don't know if that's what's going to happen, but I do see similarities as I look at this chart. Big move up. There's your PPO getting up to 1.5. Here we pulled back and then we kind of tried to come back up again here. And you can see that rollover of the PPO. Here we get up, we're pulling back, we're trying to come back up. Notice that PPO not really budging back to the upside. So if the S&P does manage over the next day or two to get up to a new high, I think it's going to come with a negative divergence in play on this daily chart. And that could lead to a sell-off back to the 50-day moving average. Now, the 50 days coming up, I see this price high over here down around 45.30 or so, 45.40. I wouldn't be surprised if we get a quick pullback. And if we do, I think it'll be followed by more buying and another move to the upside. But I'm just nervous in the near term. So this to me is more of a short-term trader issue, not a buy and hold issue. If I was someone who just was a buy and holder for the long term, I wouldn't even be batting an eye right now. I would continue to hold. Market's showing me no signs of a long-term sell-off. So I would be comfortable holding long-term. But short-term, if you're constantly putting your capital to work and, that's basically your product, if you're a short-term trader and it's your business, then protecting that capital is pretty important. I think the risks are increasing. I'm not going to say that, certainly never a guarantee prices are going to go lower, but I definitely think risks are increasing. You can see here again, move up. If we do get it, we're probably going to get it with a negative divergence. So I wouldn't be surprised to see something like we saw back in April, May, little choppiness, maybe even a sell-off around the corner. Options expiring, that always makes me nervous as well. And I'm going to give you a final reason here why I think the market could be facing some pressures here in the near term. Here's a chart over the last 10 years of the VIX. And what I've done here on the top, this is the daily action, but I've used an invisible chart. So you don't see the daily action. Instead, what you see is this 5-day moving average. So when you put in an invisible chart and then you put in an overlay, this is what's going to show, just the overlay, because all the daily data, all the noise is factored out. It's invisible. So you're only seeing the moving average. So here what you can see is the VIX 5-day moving average over the last 10 years. I'm not really overly concerned about this part of the chart. What I am concerned about, though, is notice the VIX right here has started to turn back up again. And it's turned up with the market moving higher. Now, the significance there is if you put this on a correlation, if you use the correlation coefficient, the VIX versus the S&P 500, what we almost always see is inverse correlation. You can see that this correlation lives down here near -1, which means it's completely opposite. They move completely opposite. So when the VIX is going up, the S&P is going down. When the VIX is going down, the S&P is going up. And that's the normal relationship between the two. Because when the S&P is going down, fear goes up. When fear goes up, the VIX goes up. The premiums get higher on options. And, that's how the market works. Well, you can see every once in a while, we actually go positive and we have positive correlation. Now, I have yet to see positive correlation occur because the S&P is going down and the VIX is going down. When the S&P goes down, my experience is the VIX always goes up. So when you see these positive correlations, generally what's happening is the S&P 500 is going up, but so is volatility. In other words, the market's getting nervous. The market's fearful, but it's fearful with the market going higher, which is unusual. And so what it just tells me is that, at least in my opinion and in my experience, the risks are higher of a pullback. Doesn't mean we're going to pull back. And in fact, if you look back in the year 2017, we had a number of these readings. And yeah, here on this one, we went sideways to down for a little bit. Maybe these, we had a little bit of choppy action. But you can see it wasn't until we put in this final high. This one in the fourth quarter of 2017, by the way, did nothing. We just kept going higher. But this one marked a significant top when we got up to about 0.7, positive 0.7. That's getting pretty positively connected, the S&P and the VIX. The only reading that we've ever seen higher than that one was the one we saw in September of 2020. And I remember writing an article in my blog that day saying I was very concerned, that we were getting extreme cautious signs. And this was one of them. And look at what we went through the next 2 months. It was, trust me, it might not look like much on the chart here, but when you're living through it day after day, it was pretty scary. I mean, we went 3,600 down to 3,200, back to 35 and change, back to 3,250. That was 2 months of torture coming off of that low. So I'm seeing, here, similar reading, volatility index going up with the S&P 500. That's a little nerve-wracking to me. Just tells me, we probably should be at least a little careful. For me, it just means raising more cash, but it can mean all kinds of things to different traders. You could maybe sell calls against your position. Maybe you buy some put insurance just in case the S&P 500 goes down to protect your long positions. You could move into cash. I mean, those who really are aggressive could short. I don't really like shorting in a secular bull market because the one thing that's the hardest for me emotionally in the stock market is when I'm very bullish the overall market, the market goes up and I lose money because I'm shorting. That to me is just unacceptable. So if I were to short, I'd have tight stops. Probably would not, I certainly wouldn't be shorting my whole account. It might be a position here or there, that kind of thing, but that's about all I would do on the short side. That's not really what some traders like to short, go long, short, go long. But when we're in an extended bull market like we've been in since 2013, when we broke out on the S&P above the 2000 and 2007 highs, since we did that back in the second week of April 2013, this market for the most part's gone up. I mean, yeah, we've had a couple rough patches. Obviously, the pandemic, the fourth quarter of 2018, the trade war. Earlier in 2018, you can see, I think that may have been trade war induced as well. We had some, problems 2015, 2016. But if you're looking at this chart, you got a lot more up than you got down. And so for me, I want to be on the long side. And when I'm, when I go through those short-term patches that I'm nervous, I'd just rather sit them out and just wait until things calm down until I feel a little stronger. Now, I will also mention that this is the most bullish seasonal period of the year. So that gives me a little angst in sitting out, but I would rather take a little bit of a risk off the table and, just kind of sit back, even if it's just for a few days to a week or maybe a week and a half, and just kind of let the market do its thing. And if I have to trade and get back in at higher prices, so be it. But I really want to make sure I'm protecting my capital as a trader. So that's why I'm just a little bit nervous here in the near term. You've got the options expiring this week. We know historically that can be a problem for the market, especially after we've had a big run. You've got the S&P and the NASDAQ. If you break out again, here over the next couple of days, you're going to very likely print a negative divergence on that daily chart, which makes me nervous. And then throw this in, the VIX moving up while the market's moving up and the history of what that means. And I think all of that combined tells me I want to be really careful here. All right, next up, I want to do scanning strategies. So what I did is I have what's called an uptrend reversal scan. And so if we're thinking the market might top and roll over, this would be one possibility, is to just take a look at stocks that maybe have been trending higher, but could be giving signals of maybe beginning to roll over. So what I did is I just wrote a scan. It's, I'm looking for stocks, New York Stock Exchange or the NASDAQ, either one. And then the rest of this is just showing the lows, just looking at the lows. So any stock that printed higher lows for 5 days in a row, but then in the current day, we printed a lower low. So you've had 5 higher lows in a row, daily lows that have been higher 5 days in a row. And then for the first time in 6 days, you print a lower low. Doesn't guarantee you anything, but it might be something to look at. And then just see from that list whether or not there are any charts that might be worth taking a gander at. Also, I put the volume. I just want to make sure the volume was I don't want to pull a stock up and see that 4,000 shares traded. I'm not going to be interested in that. So I just made, 300,000, but you could use whatever you want. And then when you pull the charts up, you can start to take a look at whether or not, stocks are liquid or not. All right, so then I went through these charts, and there were 20 of them that came back with the scan, by the way. And when I looked at them, probably 17 or 18 of them not interested in all. First of all, this has been downtrending for a while, went up, and it started to roll back over again. But I'm not interested in trying to short something that's been on a downtrend for that long. Then we got other stocks. This one is kind of interesting in that it's got a reversing candle, bearish engulfing candle, right at the recent highs. So this could be a short-term top. But a lot of times, it's been trending higher. Maybe it goes down the 20-day. So price is $12.50, 20 days, $11.78. So you're talking about 74 cents to the downside, which is maybe about 6%. To the upside, though, your high, if you wanted to set a stop, maybe it's above that 13.15 level, 63 cents to the upside. So you got 63 cents to the upside, and you've got 74 cents to the downside. So I'm not sure the reward risk is really there. Best Buy. Now, this one I do find pretty interesting. It broke out of a long-term base, so that's all bullish. But that is a pretty significant reversing candle, bearish engulfing, and you can see the heavy volume. And this one's got, maybe another $6, $7 down to the 20-day moving average. So if tomorrow, Tuesday or Wednesday, whatever, let's say it moves back up to 135, that might be a pretty decent reward to risk trade on the short side. So this was one that, just kind of caught my eye. BQ, downtrending, not really interested in that one. CNC, pretty close to this resistance area. Looks like maybe the PPO is starting to roll over, and it rolled over from this level back in May when we had a pretty significant decline. So I don't know. This one kind of looks interesting to me. Keep a fairly tight stop if it goes back up above about 76.25 to the downside and looking maybe down to 72. So maybe 3-to-1 reward to risk, something like that. Doesn't look too bad. Camden Properties did put in a lower low for the first time in the last several days, but it closed on the high. So I'm looking for something that finishes weak. So I'm not going to be interested in too many stocks that are closing on the high. EXC did the same thing, closed on the high. Gilead gotten up to, key area of resistance around 68, trying to roll over, but it is trading above its 20-day. This one's, just a little bit more of a mixed picture. Gates Industrial, GTES rolled over. I do like industrials, though. So this one makes me a little bit nervous. I don't want to be shorting a stock in an area of the market that's just broken out. So I'm a little nervous about that. Probably would pass there. HTA ends up on its high. Does have a pretty nasty divergence, though. So maybe if we get a reversing candle, this is one I'd consider, but not based on the way it closed on Monday. All right, then we got Johnson & Johnson, which on Friday had printed this reversing black candle on heavy volume. Well, we did move lower. So we got some support coming in pretty soon. So this isn't one. I don't think a short candidate at this point would be good there. Kellogg finished high, near the high of the day, so I'm going to pass. Same thing with Kimberly-Clark. PHAS made a huge move down, but it's only a $3 stock. It's kind of in the middle of a range now. Looks like it's probably going to go down and test this 270, 275 area, but it could just as easily be up 30 cents tomorrow. So I would probably pass on that one. QD, I'm just seeing sideways. I'm not really seeing a trend reversal because it was mostly going sideways. We did have rising lows for several days, but for the most part, it's just going sideways, and it's only a $1.70 stock, not really my cup of tea. Regency Realty, been trending higher, but I'm not really seeing anything here close to the 20-day. Strong PPO, so it might pull back a little bit, but I'd be a buyer on the 20-day. Rexford Industrial closed on the high. We do see a slight negative divergence, though. I got to see a reversing candle there first. Now, Tenneco was interesting to me. It isn't a downtrend, but over the last 5 days, it's come back up. And the 20-day moving average has been, for the most part, pretty difficult area for the stock. Now, when it has gotten through, like here, we had a slight positive divergence. It went to the 50-day, so it's been downtrending below the 50. But consistently, the 20's been below the 50 and price has been below the 20. So possibly we're getting another topping of this and rolling over. But volume back, last 3 or 4 days or 5 days, volume's been pretty strong on this bounce. But notice we're closing well off the highs each day, which has been leaving us with this falling AD line. Mixed signals again, but this one in a downtrend and having bounced recently, we might see 50 to 75 cents downside there. XENT just been going sideways, probably a buyout. Not interested there. Zynga bounced up to the 50. I mean, it closed back above about 780. I would be careful of. Otherwise, there is a chance it pulls back to test gap support around 7. And so those are the stocks that came up on that. Let's move on to the earnings spotlight. Just got a couple more minutes here. I did want to point out on the earnings spotlight one stock, though, that really blew it out of the park after the close, and that's Axon Enterprise. This is a defense stock. And if you look, the stock bottomed versus its defense peers all the way back in May, came up, and now has just kind of been going sideways for the last 3 months. Well, it's going to be going sideways no more. They were expected to report 27-cent earnings. They came in at $1.17, stock up 20% after hours. So it is likely to be up, challenging the February high at the open on Tuesday. So AXON, I thought, had a really good report. And I would just say this, if it opens above 203.51, I think there's a good chance that it is starting a bigger move to the upside. If it opens below that 203.51, then I think we got to see if we can get the closing breakout. And if you go up and you fail and you come back down intraday, that could be a topping candle on that gap up with earnings. So keep that in mind. AAP, Advanced Auto, also reported earnings. I'll give you this one quickly. They beat, but they were down 2% after hours. I think that could be an opportunity. I'd be watching that rising 20-day. I think that could be an interesting area. One other one I will give you, LCID. They missed. They were expected to lose 22 cents. They lost 41 cents. Stock was up 1% in after hours, though. So it is trending higher. At some point, we'll probably get that 20-day test. I'd probably be holding out for at least that. All right, moving on to the 3 you must see. I'm going to start off with TXG. TXG failed to hold gap support. I wrote an article in the Don't Ignore This Chart blog. You might go check it out. But if it couldn't hold 159, I was looking maybe for another $10 down to 149. The interesting part of this chart, though, it keeps going lower, and its AD line keeps going higher. Looks like it's being accumulated. Next stock, SAVA, SAVA. Stock has pulled back close to this gap support area. It gapped up on really heavy volume. So I think the upper 50s, I'd be watching that pretty closely. Could be an area where we reverse back to the upside. And then the last one I have for you is SWIM, SWIM, which is Latham Group. Big move up. This is a little bit of a concern on a reversing candle. The breakdown occurred just below $24, and we went up and tested 24 and then reversed, finished on the low. This is one that could struggle in the near term. All right, that's it for me. Check us out over at Earnings Beats. Love to have you come on board, take out a 30-day trial. Got a big event on Tuesday, Max Payne, another big event on Thursday for our draft. Love to have you come over. So anyway, everybody have a great day. I'll be back Wednesday morning over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.